Back, Federal Reserve Chair Jerome Powell was in the hot seat on Capitol Hill today as the economy continues to serve up mixed messages and uncertainty. With inflation still bringing pain at the grocery store and energy bills, Powell says more rate hikes are likely coming, but the worries are continuing to grow over what that could mean for our economy and for millions of workers going forward. CNN's Mike Valerio joining us live from Los Angeles right now. So, Mike, what can you tell us?
Well, Tom, good evening to you. You know, in terms of what this means for our wallets, if these rates go up higher than expected, that could mean paying off your credit card and taking on new loans, Tom, would be even more expensive.
The economy is running red hot. Inflation heating up in January, along with consumer spending and job growth. But cooling it down may be painful.
Although inflation has been moderating in recent months, the process of getting inflation back down to 2% has a long way to go and is likely to be bumpy.
In his testimony before the Senate Banking Committee on Tuesday, Federal Reserve Chair Jerome Powell took a hawkish stance on battling inflation as the central bank awaits key pieces of economic data, like the February jobs report due out this week.
If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes.
Powell confident the Fed will be able to rein in inflation and get the economy on track.
There are some things that we can't affect, but over time we can achieve 2% inflation, and we will.
But the bank's aggressive position sparking fears of recession and job loss.
Cooling the economy means laying off workers. When you're slowing the economy, you're trying to put people out of work. That's your job, is it not?
You are gambling with people's lives.
Though Powell remains optimistic,
we actually don't think that we need to see a sharp or enormous increase in unemployment.
Some economists warn continuing to hike interest rates is still likely to bring about a downturn.
My guess is that the process of bringing down inflation will bring on a recession at some stage, as it almost always has in the past.
Tom, you know, we've seen this movie before, but we were not expecting things to perhaps lead into a half point increase in terms of rates. So what could become more expensive? Right there on your screen: mortgage loans, credit cards, auto loans, and student loans. So again, the rate hike is all to cool economic activity in the vein of bringing down prices. So those four areas that are so crucial to everyday life could, of course, become more expensive with this expected rate hike, Tom.
Well, and Mike, of course, we're at a disadvantage in Hawaii anyway because the cost of everything else is already at a premium from being shipped in. You factor in those interest rates going up faster than expected after they pumped the brakes earlier this year. What can we expect to learn in the next few days about that part of it?
Sure. So on Friday, we're going to have a jobs report. And then when we look to next week, we're going to be looking at how inflation affects both the consumer and business side of the equation. So, Tom, when we're looking at those three factors, and if all of those three subsets come in hot, that gives the Fed more ammunition to raise rates. Again, not by a quarter point, which is what we were all kind of expecting, but raise rates by a half point. Again, the function here is to cool down economic activity, to bring down demand. And what that does is hopefully bring down prices, Tom.
All right, well, we're all looking forward to that. All right, well, Mike Valerio, keeping an eye on it for us from Los Angeles. Thank you so much.